Well, good morning, good afternoon, good evening, everyone. Thank you so much for joining today. I think we can probably get started considering the time. Let me please first allow me to introduce myself. My name is Alfredo Vicencio, and I'm an evaluation specialist for the Climate Investment Funds, leading our Clean Energy Learning Laboratory, CEL, which was founded in September of last year to support countries accelerate energy systems transformation through peer learning, expert exchange, and capacity building. One of Cell focuses over the past year has been included to support the industrial decarbonization program through a set of initiatives such as webinars. We had a long virtual clinic on GHG emissions modeling for industrial decarbonization. We had an in-person event as part of the launch of Cell in Cartagena last year as well to go through the SIF investment criteria. And in this context, today, Cell brings a virtual event that is comprised of presentations and a panel, where our speakers will showcase how the recently approved IPs for both Brazil and Mexico for industrial decarbonization program have mobilized considering an unprecedented amounts of private sector financing. But without further ado, I'd rather pass it along to Daniel Morris, our head of clean energy, so that he can speak a little bit more about it. Danny, over to you.
Thank you, Alfredo, and good day to everyone who's with us, whatever part of the day it is for you. I hope you're having a pleasant one, and we're very glad to be hosting you on this webinar. The main topic is industry decarbonization, and while I'm sure many folks on the call know some of the numbers, I'll just reiterate that it remains one of the biggest challenges we have in terms of reducing global emissions. The industry currently accounts for 1/3 of global greenhouse gas emissions, and we would need decreases in that amount by 20% in the next 4 years to 2030 and 93% by 2050 to meet our climate goals. Much of those reductions are going to happen in the developing world. 75% of new industrial capacity through 2050 is coming in emerging markets. That's where we'll really have to fight the battle on greenhouse gas emissions and where it will be won or lost. So decarbonization of industry isn't just a climate priority, it's an economic priority and a strategy to help develop new types of markets and new economic activity. Green industrial products represent about a $2 trillion opportunity in the next 4 years. So those numbers are a lot. I think it's important to reflect a little bit that how early stage and how nascent industry decarbonization discussions have been over the past few years. For those who have been in the international climate space, it's important to recognize that 5 years ago, industry decarbonization was recognized as a challenge, but not one that was spoken about at all. To now, today, and I'm speaking in part from participating in London Climate Action Week a few weeks ago, it is front and center in discussions on one of the most urgent areas for climate action. So that's a really fast change in terms of international discussions, but things like finance don't immediately shift course in response to the types of discussions we have in international meetings. And so it's important to recognize that it's going to take a little bit of time for us to really understand how industry decarbonization works from a financing and development perspective. Just to give you a sense of that, the OECD came out with a report last month that said from the year 2000 to 2023, only 1.5 billion in public finance reached steel, cement, and chemical sectors in developing economies. So we are really talking about a new space. And we in climate investment funds have been working in this space for a number of years, trying to get our industry decarbonization program up and running. We are now very glad that it is, and we're looking to show what concessional finance can do to help shift the conversation even further and really facilitate the development of low carbon, zero carbon supply chains. To that end, we last year invited 7 countries to prepare transformational investment plans. We call them sectoral transformation investment plans, or STIPs, Two of those plans, one in Brazil and Mexico, that we'll be discussing today, were endorsed by our trust fund committee last month, meaning that they are now have the green light to begin developing projects. Um, we expect that these two plans combined will result in more than 5 billion in co-financing. And we're looking for the other five countries we invited to join suit. So we're talking about a significant increase in resources focused on this issue compared to what has been in the past couple decades. Now, the way that we do this is we start with public finance that CIF can provide and our MDB partners can provide, but the private sector is a key part of that, and that's really the focus of our work today. So we in CIF designed our program really to try to support private sector in an unprecedented way from our perspective. We allowed these investment plans to focus a minimum of 50%, but up to 100% of the resource envelope that we provide on private sector activities. We also put in a number of opportunities for private sector to come in at an early stage and get involved in the development of the project pipeline. We hope that these measures that we've taken can really facilitate the growth of private sector activities in the markets where we're already working, and then the lessons that we take can be spread far beyond that. And I think today we're going to focus on those lessons. So with that, let me turn it over to Siddharth Dasgupta, industry decarbonization lead for climate investment funds, to walk you a little bit through what we've helped and support Brazil and Mexico to do in their work. Sid, over to you.
Thanks, Danny. And first of all, good morning, good afternoon, and good evening, depending on where you're joining from. And welcome and thank you for making the time. I'm Siddharth Dasgupta, and I lead the industrial decarbonization portfolio and the program at the Climate Investment Funds. So I'm actually just back from an ITA LAC sort of a event where the entire 2-day event was revolving around the CIF programs, which CIF industrial IPs, which were approved last month for Brazil and Mexico. And it just gives me that kind of an opportunity to reiterate what exactly that sheer momentum of that particular gathering was. And let me start with the numbers that actually puts this session in context. So steel alone accounts for somewhere between 7 and 9% of global emissions, if I'm not wrong. And that is more than every passenger car in Europe and North America combined. So let that settle for a moment. And along with that, another hardest to abate sector is cement, which releases more CO2 than global aviation and shipping put together. Not close to it, more than it. And once you count the electricity these plants draw and the freight that feeds them, the heavy industry, its supply chains, it's at roughly 40 to 42% of the problem. And against that, industry has historically drawn a low single-digit share of global climate finance. And that's sad. However, things are changing. 40% of the emissions, kind of a rounding error of the money, but that gap is the entire reason this particular program at CIF exists. Now, the second set of numbers. Last month, Brazil and Mexico became the first countries under the industrial decarbonization program to have their respective investment plans getting endorsed. $250 million each, combined of $500 million in concessional finance from CTF, Clean Technology Fund, with more than $5 billion, approximately $5.28 billion in expected co-finance behind it. Now, Brazil's structure alone carries a leverage ratio above 12 to 1. And that multiplier is the whole point. And it is also the whole test. So the concession number is the smallest one on the page. It only matters if it actually moves the other 10 to 12 times. So the next 90 minutes or so, I'd ask you to listen for mechanics coming from the seasoned professionals from these two countries, and of course, our MDB partners. What exactly is the mechanics rather than the ambition, and what risk is coming off the table? Who is kind of absorbing it, and at what price? Where policy is doing the work and where it actually isn't, and what still doesn't clear at these kind of committees. So a thank you to our speakers, Cesar Flores from Mexico, Cesar White Flores from Mexico's SHCP, Lucas Reyes from BNDES, Thomas Monducci from IFC, and Ines Ardelet from IDB Invest, and to my colleague Daniel Morris, as well as Alfredo, for taking this initiative along. I will probably join once the question and answer rounds come. Over to you, Alfredo.
Thank you very much, Sid. Let me then allow me to introduce our next speakers then. We do have César Vives, who holds a bachelor's degree in accounting and finance from Universidad de las Américas de Puebla and a master's degree in finance from the Instituto Tecnológico Autónomo de México. With nearly 20 years of professional experience, he currently serves as the head of Public Credit and International Affairs Unit at the Ministry of Finance, where he leads the federal government's operations in financial markets and spearheads initiatives to ensure public debt sustainability, as well as the structuring of financing mechanisms that drive the development of public infrastructure across the country. Without further ado, Cesar, over to you.
Thank you. Good morning and good evening, everyone. Thank you for the invitation, for all the organization from the CIF team. Thank you, Alfredo, CIF, and Danny. On behalf of the Public Credit and International Unit from the Ministry of Finance in Mexico, it's a pleasure to be here with you. And also, I want to introduce my colleague, Raul Gonzalez, who is the Director of Sustainable Finance, who will also support me on this presentation during the Q&A session. Mexico's Industrial Decarbonization Program tells the story of how credible investment plan can pull private capital off the sidelines. And it's a roadmap other than country can adapt to their own circumstances. So next slide, please. In the agenda, today we walk through that story of 7 connected building blocks, how climate targets become investment silos, how we identify the barriers standing in the way, the 18-month journey through the ST process, the stakeholders who shape it, where decarbonization actually happens on the ground, why we choose the financial model we did, and how a relatively modest concessional envelope multiplies into a serious private capital. The next one, please. Mexico didn't start from a blank page. We anchored the plan in commitments that already existed. Our National Development Plan, the Plan Mexico, the NDC 3.0, and the National Climate Change Strategy, rather than inventing new policy from scratch. The message is clear. Mexico climate policy is sending a clear market signal. The industrial decarbonization is not a constraint on growth, it's the national growth agenda. For Group B, that's the starting lesson. Map your own national target first. That mapping is what tells investors decarbonization is a growth agenda, not a side project. Before designing any instrument, we mapped 4 categories of barriers standing between Mexico and industrial decarbonization. The technological constraints around early stage technology and grid capacity, a financial gap of 6.7 to 10.8 billion a year, persistent gender gaps in participation, and waste across industrial sector and regulatory landscape without binding standards yet. The lesson for other countries is to diagnose which of these barriers is most severe in their own context before designing a solution. None of this happened overnight. As you can see in this slide, Mexico's STIP plan is the result of a rigorous multi-stage progress. The journey ran nearly 12 months, from CIF's global call for proposals where Mexico ranked second of 26 applicants, through technical dialogues, a joint mission, and public consultation, to final approval by the Trust Fund Committee. The lesson worth on the line is that a credible plan takes sustained, staged work, not a single submission. Next one. The stakeholder engagement process ensured that STIP was grounded in technical evidence and shaped by direct input from key actors. The process included 67 participants across 52 institutions spanning government, industry, academia, and social society, plus dedicated engagement on gender and social inclusion. The result is a plan built with the stakeholders who will implement it, to strengthen its legitimacy and impact. The lesson: bring the private sector in from day one, not after the design is done. The STIP is structured around two complementary components that address both industrial transformation and the broader ecosystem needed to enable it. The component one targets the four hardest to abate sectors directly: cement, steel, aluminum, and chemicals. And the component two targets the shared ecosystem around them: energy infrastructure in industrial parks, circular economy solutions, and electrification of logistic fleets within and adjacent to industrial parks. All projects must meet clear eligibility criteria. They must align with Mexico's national climate and development strategies, demonstrate greenhouse gas reductions, integrate gender and social inclusion principles, and comply with the MDB and CIP requirements. The key message is that systematic change needs both plan level and ecosystem level investment. Now we will move to choosing the financial model. There is no one-size-fits-all financial model. The right approach depends on each country's fiscal space, market maturity, and investment needs. For Mexico, a non-sovereign window was the best fit. This reflects its mature financial ecosystem and the existing role of national development banks. A non-sovereign model catalyzes private investment. Concessional finance is used to attract private capital rather than replace it. And this means, one, it targets market gaps. Public resources are directed only where commercial financing is not yet available. Second, it preserves market signals. Projects continue to compete on their market-based pricing, avoiding unnecessary distortions. And third, it maximizes the impact on concessional finance. Limited public resources are used more efficiently to mobilize larger investment. The lesson: every country should first assess its own situation and market maturity. That's what determines the right channel. The next one. In terms of the leverage, the STIP's $250 million in concessional finance is expected to catalyze nearly $2 billion in total investment, achieving an overall leverage ratio of about 1:7. The financial structure has three layers: $250 million in concessional resources from CIF, $480 million in co-financing from MDBs, and approximately $1.2 billion mobilized from the private sector. Together, this creates a blended finance model where concessional capital reduces risks and attracts both multilateral and private investment. The program operates on a non-sovereign basis using debt, equity, or warranties, depending on each project needs. The concessional support is tailored to each project and gradually decreases as technologies mature and commercial financing becomes viable, with investment prioritized based on project readiness and additionality. The key takeaway is that concessional finance should act as a catalyst, reducing risk, mobilizing private capital, and gradually stepping back as the markets mature. The next one, this map shows the geographic distribution of the priority industrial sectors across Mexico. Understanding where these industries are concentrated helps identify regional decarbonization opportunities, target investment more effectively, and design place-based financing and policy interventions. Finally, Let's conclude by discussing some of the key lessons for scaling industrial decarbonization finance. First, climate finance should be anchored in national industrial and climate strategies. When financing is aligned with long-term national plans, it creates certainty to support low-carbon industrial projects. Second, there is no one-size-fits-all approach. Financing mechanisms should be tailored to each country's specific needs and circumstances. Third, concessional finance should be used strategically. It should reduce risk for early projects and encourage private capital to participate. Fourth, financing should be combined with technical assistance. Funding alone is not enough. Technical support helps improve project design and implementation. Fifth, successful programs require broad stakeholder engagement. Governments, industry, multilateral development banks, academia, and civil society all need to be involved to ensure a strong ownership and long-term success. Finally, multiple barriers must be addressed at the same time. Industrial decarbonization requires overcoming financial, technological, regulatory, and social barriers through an integrated approach. These 6 lessons reflect Mexico's experience, but the real challenge is adapting them to your own country's context and priorities. Thank you very much. That's all from my part.
Thank you very much, Cesar. We really appreciate your presentation. It's very comprehensive and straight to the point. Thank you for also sticking to the time. We appreciate it. It's always valuable on these webinars. Let me pass it over to Lucas before we go to questions and answers. So Lucas Reis is a senior climate finance lead for Brazil's National Development Bank, BNDES. Lucas has held different roles with BNDES, notably leading the creation of the climate risk framework adopted by the bank in 2024. More recently, he has joined the Secretariat of the Brazilian Investment Platform, where he's responsible for institutional engagement with the Climate Transition Network and the development of de-risking mechanisms focused on unlocking climate-positive projects. He holds a bachelor's and a master's degrees in economics and a master's degree in business administration. Lucas, without further ado, over to you.
Hi, good morning, everyone. I hope you're having a pleasant morning or afternoon, depending on where you are. So I'm here to talk about the Brazilian recently approved investment plan by the CIF board and our country platform approach for this program. So let me just start off just by summarizing a little bit of what the program looks like. So many of you may already know, but CIF has just endorsed our investment plan, which comprises of 250 million concessional funding for industry decarbonization projects. And that concessional funding, we expect to be able to leverage 12 times in private capital for the projects considered here. So amounting to around $3.2 billion in mobilized investments. So the program is structured in 3 strategic investment lines, which are low emission industrial solutions, energy efficiency, and transition infrastructure. We are considering 3 prioritized subsectors here, which are low emission iron and steel, low emission cement, and chemicals. This program has, the big task of addressing very big barriers in the industrial transition scenario in Brazil. So we are seeing a lot of sector specific, but sometimes also more high-level barriers that these projects are facing. So we're summarizing here a little bit the barriers that we're seeing, but we're seeing financial barriers, institutional barriers, technological, infrastructure barriers, social, cultural, and regulatory. I'm not going to go into details on any of these. I can take questions from you if you want more details, but the point here is these projects are very complicated and first of a kind in general, and they're facing barriers and risks that financiers are not used to addressing or taking in the country or actually internationally. So we need a set of solutions to be able to make these projects actually investable and bankable by commercial banks in combination with concessional funds here. So the point of the program is to provide a set of solutions that will address these barriers, be it in terms of concessional finance and de-risking, technical assistance, both from a technological but also a gender and equality perspective, and also policy support. And what is very unique of the Brazil program is that it is based on our country platform. So Brazil has created its own country platform, which is called the BIP, back in 2024. And I'm going to talk a little bit more about the structure of the country platform. But here is just to highlight how the combination of a country platform with a CIF IDP concessional finance is going to make it possible for these new sectors to develop and these investments to actually happen and have a big decarbonization impact in Brazil. So the BIP, the Brazilian country platform, in general, it aligns the investments, the potential investments with the country's national priorities, the decarbonization priorities. It also coordinates stakeholders across the investment ecosystem, be it financial institutions, but also climate initiatives that are very close to our mandate. And it builds a pipeline of eligible investment opportunities that will serve as, and it serves as a platform for financiers, but also making sure that these investments are aligned with national priorities. The CIF IDP here has a purpose of improving investment readiness of projects and sectors, strengthening bankability of projects with mostly the technical assistance component, and also mobilizing capital, enabling MDBs and BNDES itself, the institution that I work for, to leverage private sector investment and mobilize capital at scale. So moving on, just to give you a brief introduction of the Brazilian country platform. So based on Brazil's NDCs and the climate transition plans created by the ministries in Brazil, we have created a country platform which aims at not only connecting or actually making it materializing climate transition goals with actual investment opportunities. So the purpose of the BIP is to make sure that we have a set of projects, a project pipeline actually, that will make sure that our goals are actually taken out of paper and actually materialize in investment opportunities and projects that will have a significant decarbonization impact in the sectors where the BIP is operating. So the platform is owned by the government, but its secretariat is led by BNDES, which is the Brazilian National Development Bank. We have a set of partner institutions that we can discuss more if you want to. So just to briefly summarize how the BIP works. So our first objective is to connect projects that are aligned with national priorities with potential investors. But recently we have been expanding a little bit our our operations. So we are also connecting investment opportunities and investors with private equity funds that align with the BIP's mandate. We have been set by the government as the locus for channeling of concessional funding to projects, which is very helpful in terms of communicating and making sure that we take advantage of synergies and align priorities with the recipients of such fundings. And we also have been spending a lot of time in understanding barriers and risk maps to create the concessional mechanisms and de-risking solutions to make sure that the projects are actually investable. So just to quickly highlight, the sectors that the BIP focus on are based on the national priorities. We have three main sectors. So we have nature-based solutions and bioeconomy, industry and mobilization, and energy. So for the purpose of the CIF-IDP, we are focusing mostly on industry and mobility and a little bit of energy. And it is important to highlight that these sectors were selected based on, one, their decarbonization impact, but also on the additionality that they presented. So well-established sectors are not considered here because they are not facing any challenges in getting financing from current commercial banks in the country. We also consider the materiality of the projects that we receive. So we want to make sure that we focus on the projects that are going to have the most impact in the country. So we have a threshold of the minimum amount of mobilized capital by each project. We have considerations also about environmental impact, socioeconomic co-benefits, the deepening of value chains, the promotion of technological development, and other considerations as well. So as I mentioned, the BIP operates in four main ways. So connection of projects, financial institutions, equity funds. But I guess, in my opinion at least, the venues where we add most value are in connecting and developing concessional mechanisms to projects and potential investors, and addressing barriers that these sectors face currently. So I guess these two have a lot in common, and a lot of our work now relies on both of them. So as I mentioned, attracting concessional capital is one very important way to address barriers, be it to just address a green premium that some of these projects and products currently have, but sometimes it's not just a matter of competitiveness. It's also a matter of risks that some of these projects face that are not insurable or not, or that financial institutions are not willing to take on. So addressing some of them is key to making sure that these investments actually happen. So we've been designing solutions for that, be it with our own funding from BNDES, but we're also trying to look at where there's concessional funding and grants available for us to create the mechanisms and financial solutions needed for that. So I guess CIF is one of the key funding opportunities that we saw for this task. So the approval of this investment plan, in our opinion, is going to be crucial for the evolution of our industry decarb projects. is going to make a big difference. Each of the subsectors in the industrial transition world in Brazil has their own specificities, and some are going to need just financing with better rates. Some are going to need more advanced solutions. And we made sure to include in our investment plan the flexibility necessary to be able to pursue each of these solutions. So we're very excited about the implementation of our investment plan. And we think that through the CIF IDP and the BIP platform, Brazil will be able to align our institutional readiness with priority investment and catalytic finance to accelerate implementation at scale. So that's it from my part. Thank you very much.
Thank you very much, Lucas, for your presentation. It's great to see not just the investment plan, but also how it aligns with Brazil's investment platform and the ambitious goals that Brazil has around it. Let me pass it over to Sid, our industrial decarbonization lead, so that he can moderate the Q&A session now. Sid, over to you.
Thanks, Alfredo. And really, really excited and keen to see a lot of engaging conversations now on. And thanks a lot for the presentations from Mexico and Brazil. So let me start with Ines. Ines, hi. Let me first introduce Ines. And so Ines Adelaide is a blended finance investment officer at IDB Invest and is based in Washington, D.C. Ines joined IDB Invest in 2023 and acts as a focal point in the institution for the climate investment funds, having supported the government of Mexico and Brazil in the development of their investment plans, respectively, for industrial decarbonization. Ines is also responsible for the design of blended finance solutions in Latin America and the Caribbean for transactions with the social inclusion and climate change mitigation or adaptation component. Prior to joining IDB Invest, Ines advanced her career in development finance at Finance in Motion, working with financial institutions across Africa and the Green Climate Fund. Ines holds a Master of Science in Environment and Resource Management, Sustainable Energy from Vrije University, Amsterdam. I'm sorry if I'm not pronouncing it correct. But thanks a lot, Ines, for joining us. And so let me start with you. And it's great to have you here. So 250 million in CIF resources against roughly 5 billion in expected co-finance. And concessional capital is the smallest number on the page, honestly, and the entire theory rests on it moving the other 20 times. So both endorsed plans lean heavily on concessional finance to crowd in commercial capital. From IDB Invest side of the table, what is the specific risk you're actually buying down in these industrial deals? Is it tenor? Is it technology performance? Or is it offtake price? Or a combination or a potent combination of all the three? Because those three need very different instruments and a very different way to tackle. And exactly at the same time, the plans tend to name all three, maybe price for none. So would love to hear your thoughts around it, Ines. Over to you.
Thank you, Sid, and thank you for having me this morning. Look, I think the simple answer to your question is all of them, because we will, like the transaction will all be tailor-made to the specificities of a project. So some of the projects will need longer tenor, others will need, like flexible amortization schedules. And what you are right to point out is that the investment plans, both of them, name all these risks, because what you're pointing out is the programmatic approach of both investment plans. So as we mentioned earlier, and as Lucas and Cesar described, both investment plans are 100% directed at private sector interventions. And so for this reason, they are designed with the particularities of executing resources for private sector investment in mind. And those specificities are the fact that the implementation timelines are different. They are faster, like we operate in faster paced environment than if it was a 100% public sector project or like program. And well, the investment are expected to operate in competitive, demand-driven markets. So then we have an investment plan or two investment plans that have to be able to adapt to this changing market dynamics. So you can expect that if you have an investment plan that is focused on one technology that you would like to impose through the concessional resources, then you have to expect that maybe this one technology will not take off in the country. It can be due to, X, Y, Z reasons in the next 4 years. And so you can expect a number of things that make you need to have this kind of flexibility and dynamism in the design of your investment plan. And for this reason, so for instance, you can expect that the pipelines are dynamic. So the projects that we see so far in the pipeline will likely not exactly be the same as the ones we see in 2 years or the one we will end up financing. And so that's why both investment plans are built with this kind of dynamic and flexibility in mind. And that was one of our recommendations from the beginning in engaging with both the governments of Mexico and Brazil in building this investment plan. It was to ensure that they have a large enough scope of eligible sectors, technologies, and activities, because of this recognition that the pipeline of project will, first it will change over time, but also it is something that will be developed over time. And even likely after the endorsement of the IP, or maybe even after the approval of a program by the different MDBs. And so, the first recommendation is that you should to not start with a fixed list of projects that will not be moving, but to really adapt to this moving pipeline. And I think it's even more relevant for smaller countries with more limited economies, where, if you just focus your investment plan on one technology or one subsector or two subsector, then you have a very limited scope of companies that would be eligible for the financing. And then you're less able to adapt to the different market dynamics. And also, I think this kind of design is really important. I mean, another justification for adopting this flexible programmatic approach with a large scope of eligible sector and technologies is that it strengthens the application of a blended finance principle for private sector operations. So this is the governing framework that is signed by the DFIs and that is underlying under the CIF private sector strategy that MDBs follow when executing private sector resources. And well, if you limit your IP to one sector technology, if it's more limited, then depending on the size of the economics of the country, you may only have a handful of companies eligible. And this in turn hinders MDBs from actually following the blended finance principles. So it was really important for us to be able to engage and to make sure to be confident that we can execute these private sector resources and then be able to mobilize the private sector to those ratios that we mentioned earlier. It was really important that the design of the investment plan was conducive to private sector investment. And so yes, those are the two, I think the two main things. And I think what I want to mention again is that the fact that we are able to follow the blended finance principle, thanks to the design of investment plans that is conducive to private sector investment, ensure that we will be able to mobilize private sector by not distorting the market, and which is the key to mobilizing private sector, right? Private capital. Because at the end, you have to prove to local banks and international investors that this project, this technology is bankable and is commercially sustainable, and that they will be able to invest in it even, without later in the future CIF resources. So yeah, I would say you are right to point out that yes, we mentioned all this kind of risk that possibly we will tackle on in the implementation of the resources, and that's because of the private sector focused of the IPs, and that's really like the way they are designed is really the reason why we believe that they would be successful and that we will be able to mobilize private sector.
Thanks, Ines. It was a nice, exhaustive answer, and it's essential to see where exactly Ines was pointing towards, and it's very critical also to see the adaptability and how how the thought process actually gone into making sure that the three instruments are being used in the most judicious way possible, and that leads to my second speaker. Exact particular thought process leads to my second speaker, Thomas Monducci from IFC. So Thomas is an investment officer at IFC, where he oversees the development and financing of early stage manufacturing projects with a strong focus on sustainability across Latin America and the Caribbean. He has a particular experience in decarbonization, circularity, and green strategies. Before joining IFC, Thomas spent over a decade in management consulting, working across various countries in Latin America, Europe, and the Middle East. He also held roles in impact investing in Africa. Thomas holds a degree in chemical engineering from UNICAMP, Brazil, and an MBA from Columbia University in the United States. So welcome, Thomas. My second question to you is from the perspective of exactly these two. I mean, we are only talking about the architecture of this, but Thomas, you sit on the investment committee side of this. And 2 plans just got endorsed. 7 countries are preparing them, 5 more to go. And the expert group's finding was very clear and loud. And it can write the strategy and still not produce a pipeline for a commercial finance, a pipeline what a commercial financier will touch. So my question to you would be, take the pipeline as it stands today. And if those projects landed on your desk tomorrow, roughly what share would clear IFC's investment screen without further preparation? And what is the single most common reason the rest would fail? Over to you, Thomas.
Hi, Sid. Thank you for that. And thank you for having me today. Good morning, everybody. I must say I was paying attention to the question to Ines. That was a very tough one, and she ended up helping me on maybe part of my question too. So maybe to get started, when you frame it as what part of the pipeline today would get investment committee approval, right, as they stand, I think we need to go back and look into the landscape for both Mexico and Brazil. And the pipeline of projects we're looking into, particularly in the hard to abate sectors, right? Most of them today are pre-operational projects, meaning in many cases, actually looking for a project finance down the line rather than a corporate finance line, right, of credit. That means that most of those projects do carry inherent risks that are not necessarily associated with concessional finance. They are associated with developing large-scale transformative projects by nature, right? So in particular, I would say there's a large number of those that are still going through very complex processes of front engineering designs, then building strategies around commercial contracts, both to supply key inputs or to have revenues allocated and structurally set up, meaning those projects will face systemic risks that are not necessarily SIF risks. So here, I think it's key to highlight perhaps a couple of those risks that we see very often. One of them is sponsor company that is behind developing that project. And the risk here is we see more than we would like that companies along the way are not able to weather complicated and extenuated circumstances, right? Of cost overruns, of project development delays, of environment changes, business environment changes along the way. Many of the solutions we're looking for, industrial decarbonization, those are associated with commodity-like features, meaning they also face commodity-like cycles in the market. And that actually will present complex situations in a multi-year project development situation. So definitely having strong proponents, sponsors of those projects is, in our eyes, a key attribute to successful ones. Also, when it comes to having a development budget set aside to bringing those projects to maturity, and not, as we joke, we say, don't change, the tires as you're driving. Looking for funding for that project development along the way may present additional complexities that early stage projects not always can endure. Definitely, we should also look at technology risk. We are certainly discussing sectors that are novel by nature, from supplemental cementitious materials in cement to green hydrogen and derivatives in fertilizers. Many of those don't yet have a full ecosystem operating across the globe at scale. So yes, we're looking also at technology risk and proven solutions, and I would name it a final fourth, which likely is the most difficult to overcome, and that is setting, structuring well done contracts, commercial contracts, especially when it comes to offtakes. We know that the market is not always willing to provide long-term cost plus solutions, but at the same time, it's part of the process of that development and those projects to try to land on the most bankable setup that will provide comfort to lenders and the broader investor landscape. So to sum up, Sid, in your question, I would say if we take what Lucas just described, for instance, on Brazil, the investment platform functions as a very well-structured way to funnel projects through this cycle. And we will mature with the projects, like Inés just also mentioned. As they progress, they will become more bankable, and we should be able to bring many of them to claim CIF funds to their developments.
Thanks, Thomas. In fact, you have touched upon one of the most significant, if not the most significant point, which is CFD, and how the contracts would really make or break things, especially when you have a product, but you don't have the offtake for at least a sustainable period of time, and how profitable would that offtake be for that particular entity in private sector. Of course, making sure the EBITDA is there and the profit projection is also in place. Thanks a lot, Thomas. And that actually brings me to two of my eminent speakers from Cesar from Mexico and Lucas from Brazil. At this point, I don't think neither of them need more introductions, so I will straight dive into the question. And Cesar, you had a great concessional envelope, and you made a choice to put it behind the industry. Not power, not transport, but where the abatement math is better understood and the deal flow is more mature. The decision was taken inside SHCP with the finance ministry's discipline and endorsement. So Mexico chose to put that envelope behind industry rather than power or transport. So defending that allocation to a finance minister who has to justify it against competing fiscal priorities. So what exactly was the thought process and how you decided upon, yes, industry is the horse which we are going to bet on, and this is something which Mexico as a country needs direly at this stage, and we have full confidence in it. Over to you, Cesar.
Thank you, Sid, and I just want to also thank Inés and Thomas for accompanying us in this process. I'm very happy to share this webinar. with you. Yeah, in that regard, Mexico chose to allocate its limited concessional financing to the industrial sector because this is where concessional resources can generate the greatest impact. Power and specifically the electricity sector and transport already have established the risking instruments, blended finance track records, and multiple funding windows globally. So the strategy prioritizes emissions intensive and hard to abate industries, such as we have already said, iron and steel, cement and aluminum and chemicals, while also including industrial parks, recognizing that decarbonization must occur across the entire value chains rather than isolated facilities. So this allocation is based on objective technical criteria. These sectors account for a significant share of industrial emissions and play a critical role in Mexico's economy and competitiveness, and face a greater technological and financial barriers to decarbonization than many other sectors. So that's a very important point that we analyze when we decide by these sectors. So concessional finance can help to overcome these barriers by reducing investment risks and mobilizing private capital that would otherwise remain on the sidelines. And also, from a fiscal perspective, this approach maximizes the impact of scarce public resources. Rather than substituting to private investment, concessional finance act as a catalyst, leveraging additional capital, supporting the industrial mobilization, preserving the competitiveness, and enabling measurable and verifiable emission reductions in the short and medium term. So this is not a bet against power or transport. By targeting industrial sectors with the highest mitigation potential and the greatest financing gaps, Mexico ensures that every public dollar delivers a stronger climate, economic, and development returns. So that will be from my side.
Thanks, Cesar. This was very helpful, and thanks for demystifying a couple of things. Why exactly you trusted this particular vehicle for the concessional resources. My next speaker and the last one is Lucas. Lucas, everyone on this call who has structured deal knows that total co-financing and private capital mobilize per concessional dollar are two kind of very different numbers. And then the second one is a lot smaller. And Brazil's plan show a leverage ratio of 1:12.7. So just to try an understanding, like how much of that co-financing would BNDES have deployed anyway, would have deployed anyway, and what precisely is the concessional tranche, unlocking that your own balance sheet may have not or could not. Over to you, Lucas.
So thank you for your question, Sid. To be honest, I guess that question is the very reason why our investment plan is entirely based in our country platform. So our goal here is to make sure that every dollar goes into projects that would not happen if we didn't have this support, this country platform support, be it with concessional funding or other types of de-risking mechanisms. So the way we created the BIP was selecting the sectors that actually have additionality or where the country platform would have additionality in supporting them. So as many of you may know, renewable projects are very popular in Brazil when they have a big decarbonization impact, but they're very well established. They are served by all commercial banks in the country. So we made sure to keep them, at least the well-established ones, out of the scope of the Brazilian country platform, because we want to use the resources that we have that are finite for projects that would not be happening if it weren't for the country platform. So having the investment plan based on the platform is a way to make sure that the funds are going to go into projects that would not actually happen if it weren't for this concessional funding. And also talking about the leverage ratio, I guess it's a combination of the types of solutions that we can bring into the projects and the different levels of maturity that we might that we have in terms of projects here. So for the less mature projects, we're gonna need more innovative solutions. For the more mature projects, it might be that there's a bit more appetite from commercial investors once we surpass certain barriers. But bringing a combination of concessional finance with maybe the creation of mechanisms that can use maybe a small amount of the funding to de-risk a much bigger pool of projects, I think is key to understanding how this plan is going to be able to leverage so much private capital. And I mean, that's a big chunk of our work right now, designing those solutions.
Thanks, Lucas. Again, extremely helpful. Just to close the panel, I have one quick question which is open to all four speakers. And it's kind of it's sort of a question which applies to everyone. So essentially, one thing which really is very unique to industrial decarbonization program, which is reaching the final investment decision. And to be honest with you, like I have spent a lot of years in this particular domain, and I've seen that multiple reasons can be responsible for being a hindrance in reaching the FID stage. It can take 2 years, 3 years, 5 years, even 10 years, and still a lot of projects with extremely high tenor or even extremely high promising rate may not still see that day. So my question is kind of twofold, and anyone is free to answer. What is the biggest reason industrial decarbonization deals in any of your portfolio may fail to reach that final financial close? One. And second, if assuming CBAM disappears tomorrow, because we are living in a very dynamic, wonky world where anything can happen, or if it even not disappears tomorrow, if it gets reduced to a significant level, does the investment case in these plans still stand to the way it is right now? So this question is open to all.
Maybe I can start answering part of your question, Sid.
Sure.
So
Lucas,
I guess this was a major concern that we had, the fact that we might select projects that will not in the end be able to reach financial investment decisions. And having the investment plan based on a framework and the platform rather than defining specific projects to receive the funding, I guess it's key in mitigating that risk, because we have the resources and we have a project pipeline. We're not sure exactly which projects are going to reach FID. We hope all of them do, but to be honest, we know that that's not going to be the case. So having a pipeline of projects that when they reach FID, they can access those fundings mitigates heavily the risk that you assume. And maybe just to introduce an answer to the second part of your question, well, I understand the world has changed significantly in the past year, and not necessarily only in terms of changes in relative prices, but also, I guess, uncertainty has increased quite a bit. And I'm sure that investors understand that diversifying is very important, be it in terms of technologies or geographies. So, in my humble opinion, even though differences in prices may still present themselves for our projects, there's a strategic component to investing in them that, in my view, has proven more significant in the past year. So I guess in this concerning or considering this point, they're more strategic than ever. They're more bigger opportunities than ever. So yeah, maybe someone else wants to complement my point.
Thanks, Lucas. This is extremely enlightening coming from someone at your position and who sees these kind of investment decision coming in and out. Ines, I saw you going unmute, so maybe you have something.
Yes, thank you, Sid. Let me try to complement what Lucas mentioned from like MDB's perspective. I think, look, the projects that we see in the pipelines, we actually do expect some of them to not reach FID, and we expect some of them to maybe like fail and not reach the level or like the level that we would like. That's exactly why, we want to adapt this flexible structure that I mentioned before. And that's exactly why I think it's really important to have the CIF concessional capital that is executed by the MDBs, because we, as MDB, we manage this kind of patient capital. And so we can try to bring a project from A to Z, like, within a scope of like a few years. And we understand that not every project will just like reach FID, very, very easily. And that's also, I think, why we need to underline the very additional like technical assistance component that is part of the investment plans of both Brazil and Mexico, where we have like for both plans up to 10 million of technical assistance that is managed by the MDBs, and where we can provide support, like upstream support, even before the project reaches FID, for bankability support or any kind of feasibility studies or decarbonization strategy, etc. So we have this envelope of technical assistance that we can really tailor to the needs of the projects, and this is really extremely additional capital that is provided by the CIF and executed by the MDBs, so that it's tailored to the project. So this is kind of our answer to the uncertainty and the risk of failure of certain projects, where we are here to push them all the way and to support them all the way until they reach FID. So that would be my answer to that.
Thanks a lot, Ines. Again, as usual, very holistic and useful. Cesar or Thomas, would you like to add anything, or up to you? It is an open question.
Thank you, Sid, and also I want to thank Lucas for sharing its experience. I also would like to pass the floor to Raul, who is here in the Ministry of Finance, since he was really involved in designing and building this framework, so he can also give us his insights on this project. Please, Raul, go ahead.
Thank you, Cesar. It's a really good and tough question, Sid. But I would say that we are trying to build a very robust pipeline of projects. So the more projects you have, the less chance of failure you have if you analyze them correctly. So basically, the IDB, the MDBs, they have their own pipeline, but we're trying to feed them. As you mentioned before, the ITALAC webinar that we had last week, seminar, I mean, allow us to create and to contact more people from the private sector so we can feed those pipelines of the MDBs and try to channel directly to them in order to make the process more efficient, transparent, and obviously stronger. So we also have kind of a quality control point where you are going to evaluate if your project is going well, or they are not reaching certain goals. So basically, we can try to change direction or shift it a little bit in order to make it successful. But on the other hand, if resources can be stopped, let's say, this is part of the strength of the investment plan. That it's not a standalone initiative, but is embedded within Mexico broader economic infrastructure, climate and sustainable finance policy frame. From our perspective of government, the industrial decarbonization is not only a climate objective, but also it's a strategy to strengthen productivity, enhance competitiveness, attract long-term investment, and position Mexico industry to compete in an increasingly low-carbon global economy. For that reason, I mean, this plan was designed in a full alignment with the National Development Plan, the Plan Mexico, the infrastructure investment plan, a different price. We are totally aligned. The safe acquisition of resources are part of puzzle, but obviously if the resources are more limited, obviously we will take more time in trying to finalize the projects that we have here. That's what is very important to use the seed resources in order to accelerate the process and to get the outcome as soon as possible. I would say that by institutionalizing these mechanisms, Mexico aims to strengthen implementation capacity and provide continuity across political transitions, ensuring also that the investment pipeline remains aligned with long-term national development and climate objectives. That would be my answer.
Thanks, Raul. Thomas, do you have anything to add?
Really not much to add from my side. That's it. Raul, Inez, and Lucas, I think, spoke very well. My brief addition would be that from the get-go, I believe projects must start from an investment thesis that stands on its own long-term without permanent crutches, right? I think we're trying to find this balance between projects that do need some level of support, concessionality, but not long-term, perennial support. That means from the get-go, you're going towards a thesis that is commercially viable, that does not depend on the long go on something that can be taken away, such as an incentive in place for a particular market.
Thanks a lot, Thomas. And with that, I will hand it over to Alfredo and see if we have any questions from the audience. And if not, then probably I will follow Alfredo's lead. Over to you, Alfredo.
Thank you very much, Sid, and we welcome any questions. I see that Gareth already raised his hand, and Mark as well. So Gareth, please go ahead.
Yes, thank you very much indeed for the presentations and the discussion. Sid mentioned CBAM, and I'd like to ask Raul and Lucas if any carbon pricing policies, domestic or international, had an impact upon the participation from different sectors of industry and how that influenced the pricing. And maybe Inez, does the presence or absence of these kinds of policies help or hinder the financing of the projects? Thank you very much.
Thank you very much, Gareth. Let me take the other two questions we have from the audience to see if we can manage the time from all answers. So Mark, over to you.
Thanks very much, Alfredo. Very nice to see a lot of familiar faces here. I had two questions, but in practice, it's more sort of two sides of the same coin. I wanted to ask the speakers if there's anything that can be said about the degree of concessionality that can be expected, both from the CIF resources, but then also the MDB resources that those would be matched with, because ultimately that degree of concessionality will dictate whether some technologies become bankable or not. And then sort of the flip side of asking that question is, and I guess this is more geared towards Mexico because we've been working for a while in Brazil, but only just getting started in Mexico, is any perspectives on the proximity to bankability of the different technologies and sectors considered in the investment plans? Because in the same way, if you have a given level of concessionality, certain sectors and technologies may be bankable enough already to clear that hurdle, but others may require much more advanced solutions. So any thoughts on that? Super welcome.
Thank you very much, Mark. And the last question from Neil, please. Welcome. Good to see you.
So thank you very much, and thank you for all the insightful presentations and also the panel. So as you may know, South Africa is developing its ID investment plan as part of the 7 countries that were selected. I mean, other than the financing issue, the issue that is popping up in our engagements is, and it's been raised by several of the speakers, and that is whether we pursue a single industry focus or a broad spread across many sectors. I mean, our position that we're landing on at the moment is that we avoid both extremes, and this is largely because of the limited resources available. And thinking is that we should be concentrating limited resources where they can be genuinely transformational, and also then crowd in significant private investment. So I think where our thinking is at the moment is on 2 or 3 priority industrial value chains rather than numerous disconnected industries or projects. And it'd be interesting to maybe get some feedback from the panelists, and maybe an opportunity also to engage the panelists further via CIF in just sharpening some of the thinking that we are having. Thank you.
Thank you very much, Neil, for your question. Over to the panelists. Whoever prefers to start, feel free to.
Yeah, maybe sorry, Raul, go ahead.
Okay, go, Lucas. If you allow me, I'll just like to say that, yeah, we do have a carbon policy. We are at a very early stage. We are developing, but we are not going to wait until it's already in place. Carbon in Mexico, the carbon policy is complex. So we're working at the same time. And it's going to be a tool, obviously. Right now it's working basically in external markets. So people go and sell carbon outside Mexico. But it's definitely going to help us to coordinate this part. I mean, decarbonization is the plan of investment, our investment plan. But on the other hand, we have different tools, and one of them is our carbon policy. So yes, this is going to help us to decarbonize, but at the same time, we're going to help the market to de-risk their investments. So trying to answer the first question, I'll say that yes, it plays a very important role, the carbon policy that we have here, but also the external policies that we have in the abroad. So it's going to be helping us to reduce the carbon emissions here in Mexico and to sell those CO2 to other parts of the world. That'll be my first question, my first answer to the first question. I'm not sure if you, Lucas, want to add something on that, and then we go back to the second question, or should I go?
Maybe just quickly add also that Brazil is establishing its regulated carbon market, and that we do consider the impact that it may have not only the Brazilian regulated carbon market, but other markets in the world might have a big role in the competitiveness of some of the projects that we have. And there's, as Sid mentioned earlier, potential for affecting the competitiveness of the projects, but we are making sure to prioritize first the less risky projects in that sense. But I'll let Raul finish his answer.
And for the second questions, the degree of concessionality, probably that part will be more an answer that the MDBs can give you, but I'll try to give you the answer about the bankability of the projects. We obviously try to identify those that are bankable, but if they are not bankable, we are, as a Ministry of Finance, work with them in order to make them bankable. And the technologies play a very important role here, and obviously we're working on that as well with other instruments. As we mentioned before, this plan is focused specifically on industrial decarbonization, meaning the secondary part of the economy. But the third part, which is services and technology and not that amount of carbon, what we're able to do is working with other projects. But yeah, where there are projects where are not totally bankable, that's where we use the technical assistance in order to support them and to make them more bankable. So yeah, if you have a specific project, probably we can talk a little bit more about it. But what I can say is that we are trying to focus with this investment plan on industry, but we can work on services as well, and on the industry and the technologies and the data centers and everything. Right? So basically, if you want to talk a little bit more about it, we'll be happy to do it.
Alfredo, I'm happy to complement Raul's answer to this question on level of concessionality. Coming from MDB first, to mention that MDBs such as IDB Invest, and without speaking for Thomas, IFC, we invest their own capital resources on market terms, and then we invest the CIF resources on concessional terms based on each project needs. And so this will really depend on the technology that is targeted on the risks that are faced by the projects. And so that is what this flexibility allows us to do. Like for each project, we will have like a specific analysis depending on the risk faced by the projects, the market context, etc. And that is what will determine the concessionality for each project. We have both IFC and IDB Invest, like a independent committee that approves the concessional terms for each project. So yeah, it is really project and technology dependent. But just to mention, that is only the CIF resources that are invested at concessional terms.
Perhaps to add on that, thanks Ines. I think you can, Mark, expect extended tenors. That is a given, right? Compared to commercial terms. And we're not at this point giving out specific rates, but the idea is that most of the resources to be allocated at subordinated tranches, depending exactly on what Inés mentioned in terms of the concessionality needed, right, for that project and size. And I'd like to connect this to the question from South Africa on selecting sectors. I think that's a very pertinent discussion. Resources are limited, right? So, of course, I don't think a country would like to end up with an allocation of a very small ticket, a concessional ticket, to a very large number of projects. So finding the balance of a couple of sectors, just like Mexico and Brazil did, that are key to transforming the industry locally, and imagining a select number of projects that will receive, that you can count on your hands, that projects that will receive that concessionality, that can really move the needle forward, especially given the level of mobilization that we're looking for.
Thank you very much, Thomas, for that answer. I see that Inés is muted. I don't know if you want to say something.
I just wanted to complement these answers to Neil. I mean, really happy to engage, on the sideline if that's useful for us. This philosophy, let's say, of having like flexible plans or programs with like a broad like each sector, like scope of sector, is really based on our experience of implementing programs and plans from the CIF and other concessional donors, and seeing that when we had a limited like focus, but we had difficulties actually for when I'm talking about just private sector investment, obviously, but we had sometimes we were facing limitations in how we could deploy the resources because of the dynamics of the sectors of the market. So this is based on it's like 10 years of experience of IDB Invest implementing concessional resources. But as Thomas mentioned, of course, you want to find the sweet spot between having everything possible and having something very restricted. So I think, these investment plans are a good example of also because Mexico and Brazil are large economies. So within each sector, you can find kind of like an ample list of like potential projects and companies that are eligible. And I think that's important.
Thank you very much, Inés, for that compliment answer. Let me pass it over to Sid for some closing remarks then, as we're getting closer to the time.
Thanks, Alfredo, and thanks to all the 4 speakers and everyone who actually were there for all the 90 minutes. So just let me be a little bit, let me just make sure that I'm precise and to the point because we have just 1 minute left. So 3 things I'll take away from today's panel and the discussion. One is on proportion. So 250 million in concessional resources against roughly 5 billion is expected in co-finance. So the concessional dollar is the smallest number definitely on the page, and that is exactly as it should be. So which means the question we owe ourselves is the one Inés and Lucas asked so honestly today, and what happened here that would not have happened anyway. So this is the line between the capital, and that is the catalytic capital, which is a little cheaper. Second would be on where projects stall. Thomas put it better than I could, and it is rarely the cost of capital, it is the buyer. So when a plan says a project is investment ready, the kind of useful follow-up is who signs the offtake agreement and for how long? And at what price? With that answer, you have a pipeline. Without it, it is a good list. And third is one on what comes after the document. So Caesar spoke about the machinery inside the ministry that turns an endorsed plan into a signed transaction. It is definitely the least glamorous part of this work and quite possibly the most important. And it deserves a page in all the plans, whoever is writing the plan right now, who's actually present in the call. And a word on the roles, because precision here is a form of respect. countries own this process, MDBs lead it. So countries set the strategy, MDBs design and deliver, and CIF reviews, and the TFC endorses. So what CEL, the Clean Energy Learning Laboratory, can add is the one thing no country can produce alone, which is the experience we have gained from years of seasoned clean technology work. And Brazil and Mexico went first, so they will also learn first. And some of that learning will be expensive, some will be very handy. To those still preparing the plans, bring us your hardest questions perhaps now. And while changing, your mind may still be a little inexpensive at this point in time. I'll give it to Alfredo for the recording and the presentations. Perhaps it'll be shared later or not. Alfredo would be the best person to guide. So the next milestone is not another convening, it's definitely the financial close. And I thank you all for your time.
Thank you very much to the speakers and to everyone. Have a great rest of your day.
Thanks, everybody. Bye-bye.
Thanks very much.
Thank you.
Bye-bye.
Thank you.